Hello everyone. Today we are going to study Chapter 11, which is dealing with the stockholders' equity section of the balance sheet. So we've been through our studies dealing with the accounting cycle, and we have also been through studies after we've gone through the accounting cycle and the preparation of the financial statements and the closing journal entries. Then we worked through all of our assets. We had chapters dealing with cash and receivables and inventory and fixed assets. We've also worked through our liabilities. Now this is one of the last chapters dealing with the balance sheet. And now we are on that third section called stockholders' equity. Once again, as a reminder, the accounting equation equals assets equals liabilities plus stockholders' equity. So we're working through that last section right now, stockholders' equity. Basically, I like to call the stockholders' equity the leftover. Once all the assets are liquidated to cash and the liabilities are paid up, whatever is left is called stockholders' equity. Stockholders' equity is broken down in two sections. Basically, we've got the original contributions from the stockholders directly. That would be called capital stock. And we've got different sections of capital stock. And then, of course, once the organization starts to actually run a business and earn profits, there we would include all of that in something called retained earnings. All right, the retained earnings account is going to be where we're going to record all of the revenues, less the expenses accumulated over time, less the dividends. Once again, the dividends is a distribution to the stockholders. Okay. So the owners of a corporation, they're called the stockholders. Sometimes you'll hear the term shareholders. They're synonymous terms. They mean the same thing. In small corporations, it's very common for there to be only one owner or just maybe 2 or 3 stockholders. However, in large corporations, like a publicly traded corporation where you can buy and sell stock freely, there literally could be millions of stockholders. A corporation is a form of business recognized under state law. There's no federal corporation law. There's actually a state law, and each state has their own corporation rules and regulations. It is a separate legal entity. It's got rights and responsibilities apart from those of the owners. That's very important because corporations, basically you get a legal liability if you own a corporation. And if you are in the business of providing a service or goods to your customer, and they happen to sue for a particular reason, they can't come after your personal assets. Basically, that corporation is limiting the liability. They're going to sue the corporation, not the individual shareholder. Okay, what are the characteristics of a corporation? Like I said, in the eyes of the law, it's kind of like another human being. They can own assets. They can have debts that they're responsible for repaying. They got to pay income taxes, fill out tax returns. They can sue. They can be sued. They can enter into contracts. Just about anything a human being can do, a corporation can do as well. Corporate form. Corporations certainly have a lot of advantages. The big one, as I mentioned already, the stockholders are not personally liable for the debts of the corporation, and that would include, of course, being liable for any lawsuits. There's transferability of ownership. We can all go on the websites right now and actually buy and sell publicly traded stocks very freely. I can become an owner of Disney in the next 30 seconds. All I got to do is go on an app and go into my investment account and buy some Disney stock. You can do it as well. It's very transferable. The ownership is changing for some of these large publicly traded corporations. Ownership is changing hands literally by the second. Professional management, of course, with the corporation, you as a stockholder, you do not need to worry at all about any of knowing the business at all. Certainly, this is something that can be done through hiring management. Management is going to be the ones that are running the day-to-day operations. You don't need to be an expert in the corporations that you buy stock in. Continuity of existence. The corporation is going to continue to exist even if a shareholder passes away. Now some disadvantages. Heavy taxation. Corporations are taxed. Just like an individual is taxed, so is a corporation. There's a lot of regulation. We need to make sure that laws and regulations are being followed. Forming the corporation, there's a lot of corporate costs that we need to make sure that we are following. Separation of ownership and management. That could be an advantage. It could be a disadvantage as well. Stockholders, if they don't approve in the way management is running the business, it's going to be difficult to move forward and take a united front. So this is something that at times it could be an advantage, and at times it certainly could be a big disadvantages. Okay, businesses incorporate, really the biggest reason in my opinion is that limited liability. Obviously the liability is limited to the assets of the business, and that is very, very important, especially if you're a small corporation. Okay. Like I said, in the U.S., state law is going to be followed when we're forming corporations. It's not formed at the federal level. It's formed at the state law. Okay. Now, the various states have different rules and regulations, but generally, an articles of incorporation is submitted to get a corporate charter. The stockholders are then going to hold a meeting to elect the board of directors. The board of directors, by the way, they set the general the general theme of the corporation, general direction. They don't run the day-to-day business. The board of directors ultimately is going to hire a management team to do that. The directors are going to hold a meeting, and they're going to appoint the management team. Okay. Forming a corporation does have a lot of organizational costs up front, and so that's something that is a big disadvantage, but it needs to be done. Okay. Stockholders, they are the ultimate owners. The stockholders vote on the board of directors, who in turn set general direction of the corporation, and of course the board of directors is going to hire management to run the day-to-day operations. Now, stockholders have rights. They vote for the directors. Okay, it's just like us as citizens of the U.S. We get to vote on our leaders in our local governments, our state governments, as well as our federal government. The stockholders do the same thing. They can vote on the board of directors. Stockholders, from time to time, if the board of directors elects, can actually participate in dividends. Once again, that dividends need to be approved or declared by the board. But certainly the stockholders do have that right to share in dividend distributions. And ultimately, we hope it never comes to this, but the stockholders do have a right to share in the distribution of assets when the corporation is over and they are liquidated. Okay, once again, the board of directors, they do not run the day-to-day operations. They set general corporate policies, general corporate direction. They hire the corporate officers that actually run the day-to-day business. They can declare dividends for the shareholders. And of course, for us, and under the accounting, it's very important that we understand that the board of directors, they actually review the findings of both internal auditors as well as external independent auditors. And that is a big deal. We want to make sure that we are aware of that. Most corporations, the head management member is called the CEO, and the head financial manager is called the CFO, the Chief Financial Officer. Okay, when stockholders become owners, their ownership is actually in the form of a share of stock. Each share of the stock represents an ownership piece. So as an example, if a corporation has 100 shares of stock that they're authorized to sell, and I own, let's say, 12 shares of the 100 shares that they've sold, that means I own 12% of the corporation. Okay, that stock has to be authorized, and the articles of incorporation that's put together will specify how many shares of stock that company can authorize. The authorization, that's basically the limit, the top amount that these corporations are allowed to issue. They cannot issue unlimited shares of stock. All right, now when that stock is originally sold to the shareholders, that price is going to be based on certain factors. Like, what do they expect the future earnings to be? The financial strength of the company, the current state of the investment market. And this is going to all factor into what that sales price of that stock is going to be. Now, for accounting purposes, the one thing you have to understand is that the articles of incorporation are going to state that each share of stock has an accounting value called a par value or a stated value. For bookkeeping purposes only, that is what the par value or the stated value is. It basically said, let's say the par value or the stated value is $1 per share. So we're going to utilize that $1 per share when we record the sale of the common stock originally to the original investor. The stated value has nothing to do with market value. So one thing you have to understand is this par or stated value is not representative of the market value. Let me give you an example journal entry so you understand this. Okay, we have par value stock that's authorized to be sold, and this particular company issues 10,000 shares of stock. The issue, that means we actually sold 10,000 shares of stock at a price of $8 per share. Okay, now this particular stock has a par value of $2 per share. All right, so the par value is $2 per share, but the selling price is $8 per share. Here is the journal entry you can see below. The company is receiving $80,000, and that is the 10,000 shares that we sold times $8 per share. So we're going to debit cash, increase cash by $80,000. Now we're going to credit the stock account. Remember, this is an equity account only for the number of shares issued times par value. The number of shares issued is 10,000, but the par value is only 2. So 10,000 times 2, that's where you get this $20,000. Any monies received above and beyond par value is going to go to this account called additional paid in capital. These are monies paid into the company in addition to the par value. Both the capital stock as well as this additional paid in capital are both equity accounts. So after that transaction, I want you to take a look at what the equity section of the balance sheet looks like. The first account we have is called capital stock. Now, it is important not just to say capital stock and put the dollar amount here. We actually also need to disclose on the balance sheet the par value, the number of shares authorized. Remember, that's the ceiling allowed. In this case, it's 50,000 shares authorized, as well as the number of shares issued and outstanding. Issued basically means the number of shares that we have sold. In this case, it's 10,000. I will explain outstanding in a little bit. So we need to prepare all of that. Now, do you see that the $2 par value is in red and the 10,000 shares issued is in red? That is always going to equal the dollar amount over here. The par value times the number of shares issued. In this case, 2 times 10,000 gives you your 20,000. And as we saw also from the prior slide, the monies received above and beyond the par value goes to this account called additional paid in capital. So that's 20 plus 60. That gives us total paid in capital of 80,000. And then the other part of the equity section, as I said earlier, is when the corporation actually runs the business and they generate revenues and they incur expenses and they pay out dividends. As I so nicely, hopefully you agree with me, nicely said in prior studies, they're called the RED accounts, R-E-D, revenues, expenses, dividends. They all go into this retained earnings account. The retained earnings plus the paid-in capital gives us total equity. Okay. So this is what the equity section is going to look like. This is going to continue to grow, so don't get comfortable with just it looking like this. We will grow it towards the end of the chapter. Some states will allow stock to not have a par value. That would be called no par stock. If a corporation does exist that has no par stock, basically the capital stock account is credited for all the money received, and there's no such thing as needing an additional paid-in capital account. This is something that I believe is very rare. Most states do require par value as to state the stock. Okay, now I've been using the term capital stock up to this point. But one thing you have to understand is there are going to be different classes of capital stock. In this particular chapter, we are going to study common stock and preferred stock. The common stock is the basic type of capital stock that's issued. Every corporation has common stock. Common stock, they'll have voting rights. They'll be able to participate in dividends when the board of directors does indeed declare them. And of course, they would stand in line as the company is liquidated at the end. The other type of stock is called preferred stock. Now, preferred stock, the reason why they're called preferred stock is because they have preference, hence the term preferred. They have preference over common stock when it comes to dividends. So preferred stockholders get in line first before the common stockholders can get paid out the dividend. They can have cumulative dividend rights. It could also be non-cumulative, and I'll explain how that works in a little while. They're also called preferred stock because they stand in line above the common stockholders when it comes to a liquidation at the end of the company's life. All right. Preferred stockholders don't vote. That's the difference. They don't have voting power like common stockholders do. All right, now let's take a look at the equity section of a balance sheet when we're introducing both common and preferred stock. You can see it's growing a little bit. And everything here in red is a little bit new. So the required disclosure items when we have preferred stock is we need to put down the dividend rate. In this case, it's a 9%. 9% of the par value. That means 9% of 100. That means every stockholder is promised a $9 dividend per share every year. 9% times the par value. It's cumulative. That means the dividends accumulate. If the dividends don't get paid out in year one, they accumulate into year two. And then in year two, they have to get paid out for year one and year two. If it doesn't get paid out again, it rolls over and accumulates into year three. That's what cumulative means. If it was non-cumulative, that means if the year comes and goes and the dividend was not paid out, it's basically erased and you start the next year with fresh zeros. You don't have to actually pay out. The company doesn't actually have to pay out that dividend. We also need to disclose the par value, the number of shares authorized. In this case, 100,000 shares are authorized. The number of shares issued, which means the number of shares that we sold, and outstanding. Common stock, once again, par value, authorized, issued, and outstanding. And then we have the additional paid-in capital. Once again, these are amounts paid in from the original investors above and beyond par value. And then we get a subtotal called total paid-in capital. We'll add to that the retained earnings account, which is the accumulation of the red accounts, once again, revenue, expenses, and dividends. Revenue minus expenses minus dividends to give us our total equity. So you can see our stockholders' equity section is continually growing. All right, let's talk about dividends. A dividend is a distribution. It's a cash distribution to shareholders. All right, for preferred shareholders, there's no guarantee ever that they'll receive a dividend, but they do indeed receive preference over the common shareholders. If they're cumulative, that means they're going to accumulate from year 1 to year 2 to year 3 until the payout is caught up. All right, dividends could be in percentage terms. Like I showed you earlier, it was a 9% cumulative preferred stock. That means 9% of par value. All right, cumulative preferred stock. That means it accumulates from year 1 to year 3. If a year comes and goes and the full dividend was not paid, it accumulates over into the next year. Let's take a look at this example. Assume a corporation is organized on January 1. It's got 10,000 shares of $8 preferred stock and 50,000 shares of common stock. All right, first, if the preferred stock is non-cumulative, that means the $8 per share dividend does not carry forward if it's not paid during the year. If it's cumulative, that means that $8 per share dividend carries forward to future years if it's not paid, and the accumulated amount must be paid out fully before the common shareholders get any dividends. All right, let's take a look at this example using numbers. Assume the $8 preferred dividend is paid in 16. Now remember, how many shares do we issue? It says 10,000 shares were issued. Okay, 10,000 shares were issued. So $8 dividend per share, $8 times 10,000. That means if the preferred stockholders are non-cumulative, and year 1 we paid out the full 80,000, that's good. If it's non-cumulative, it's paid out and there's nothing in arrears. If preferred stock is cumulative, we paid it fully out. That means there's nothing to carry forward. That's what this means, dividends in arrears. Arrears means it's behind. Okay, 2017, once again, $80,000 of dividends are required to be paid to these preferred shareholders. In 17, how many were paid? 20,000. If it's non-cumulative, we don't say anything is behind. But if it is a cumulative preferred stock and we only paid out $20,000 and we had to pay out $80,000, that means $60,000 gets carried forward to the next year. In the next year, we paid out $0. So after 2 years, we owe $60,000 carried forward from 17 plus the full $80,000 for 18. That is $140,000, and it's going to continue to get carried forward until they are paid out fully. Only up to that point will the shareholders, the common shareholders, actually have any chance of getting a dividend. Okay, so dividends in arrears. They are never, once again, dividends in arrears are not included as liabilities. All right, it's not like we're going to record a liability on our balance sheet. However, we will put a footnote in there with the financial statements. The readers of the financial statements should absolutely know the amount of dividends that are in arrears. Okay, so where does a company get its money? Once again, the stock, the original sales of stock, that would be preferred stock or common stock, plus the business operating either selling goods or services. That would be the retained earnings. These is where the red accounts go. The revenues, less expenses, less dividends. Okay. The common stock, the value of the common stock, that is called the book value. All right, the book value is different than market value. All right, the common stock might have a book value of a certain price, but the market value could be a lot higher. So let me fast forward here to look at market value. Okay, market value is actually what the stock could be sold on today's market. If it's a publicly traded company, the market value is very easily attainable. All you got to do is look at the Wall Street, NASDAQ, Russell 2000, whatever stock exchange, you will easily find the market values of all these stocks. It is what the price is, the going public price, market value. It's a little bit more difficult when it's a small corporation. You actually have to do some sort of market valuation. All right, it's not an easily obtainable market. Market price may differ substantially from par value, from book value. All right, it could be a lot different. Okay, so us, we're the company that's selling the stock. When we sell the stock, all right, we're going to record the original journal entry, the original sale to our stockholders. All right. As the shares get out into the market, if we're a publicly traded company, and then I buy from you and you buy from somebody else and that other person buys from somebody else and that other person buys from somebody else, right? We can have literally millions of shares changing hands by the day. The company doesn't need to record journal entries for any of that. That is just a transaction between two investors. The only accounting that's done by the company itself is when they sell the original shares to the shareholders, the original shareholders. Okay? Now, the investor, you're going to see this on the balance sheet as an asset. If we are a company and we own shares of another company, we have an asset called investments. All right. In the prior chapter, we called it marketable securities, if you remember that. And of course, marketable securities, the current value of those securities are going to be stated on our balance sheet as an asset. All right. So be very careful. Are we the issuer, meaning we're issuing the stock, or are we the investor? If we're the investor, we have an asset called marketable securities. If we are the issuer, obviously that affects the equity section on our balance sheet. Okay, the market price of preferred stock, just like common stock can have a market price, it's influenced by a number of things. But the market, the free capitalistic markets are setting the price. And usually what's taken into account are dividend rates, risk, market interest rates play a part in setting the price of preferred stock. Common stock, it's really the financial performance of the organization. It goes a long way into setting the price of common stock. And this is what Wall Street analysts do all the time. They basically try to tell their clients what a good price is to buy a certain stock. They're analyzing these companies all the time. They're basically telling their clients it's time to buy, it's time to sell, or it's time to hold on. Okay, another concept, stock splits. This is when a share of stock actually splits into different pieces. Now, let's say it's a 2-for-1 stock split. That means one share of stock is now turning into 2 shares of stock. When we have a stock split, what we're doing is if it's a 2-for-1, we're doubling the amount of shares outstanding. Meaning the number of shares that are out there are now double. And what we're going to do is we're going to cut in half the par value. So let's take an example. If we had 1,000 shares outstanding and the par value was $8 per share, and now we went through a 2-for-1 stock split. Now all of a sudden, instead of having 1,000 shares outstanding, we have 2,000 shares outstanding. But the par value goes from $8 to $4. So just be aware, we could have a stock split, and this could happen. There's no journal entry needed for a stock split. You can see that there's no journal entry. There were no selling of stock, no buying of stock. We simply have to change our disclosures. We change the par value, and we change the number of shares outstanding in our disclosures on our balance sheet. treasury stock. What is treasury stock? Well, treasury stock is when the company buys back their own shares. You may have heard this from time to time, that a company goes through a buyback program. They're simply buying back their shares because they truly believe in their company and they believe that the stock is undervalued. And so when a company buys back their shares, that is called treasury stock. Treasury stock actually reduces, yes, you heard that right, reduces the equity of a corporation. All the other equity accounts, common stock, preferred stock, additional paid-in capital, retained earnings, they all have credit balances. But the treasury stock has a debit balance. Effectively, it is called it is like a contra equity account. It is reducing the size of the equity. Let me give you an example. So a company goes in and they purchase their own shares. They're going through a buyback program. For example, Riley Corporation reacquires, they're buying back 1,600 shares of its own $5 par value stock, but they buy it for $90 a share. Here's the journal entry. We're going to debit this account called treasury stock, in this case 1,600 shares times the purchase price, which is $90 per share. That comes to $144,000. And we wrote a check, so we're going to credit cash for $144,000. This treasury stock reduces overall equity. It is a contra equity account. Now, let me just show you, what does the equity section look like after we buy treasury stock? Well, we still have our common stock. It's $5 par value. 250,000 shares are authorized. 100,000 shares are issued. But how many shares are outstanding? 98,400 shares are outstanding. The difference between issued and outstanding is what's in the treasury. That's why it says here in brackets, 100,000 shares are issued, of which 1,600 shares are held in the treasury. That means the outstanding shares are issued minus the treasury. All right, the 500,000 is still the 100,000 shares issued times $5. There's your additional paid-in capital. That gives you a total paid-in capital plus retained earnings, gives us another subtotal, and then we're going to subtract out treasury stock. Once again, all these numbers here have credit balances, but the treasury stock has a debit balance. So yes, the treasury stock reduces equity. It is a contra equity account. Now we go, and out of the 1,600 shares that we bought, now we're going to sell some of it back. Let's assume that out of the 1,600 shares that we originally bought, 1,000 shares are going to be sold. Now we're going to sell them back to the investing public at $115 per share. Here is your journal entry. I'm going to debit cash. We actually received 1,000 shares times $115. That gets you to the $115,000. Now here's the accounting that you really need to understand. We're going to credit treasury stock when we sell it back. Now it came into the treasury at $90 a share. It's going to come out of the treasury at $90 per share. That is why we credit treasury stock, not for the full $115,000, but for $90,000. Once again, it came into the treasury at $90 a share. It's going to leave the treasury at $90 per share. Any monies received above and beyond, all right, the original price is going to go to additional paid-in capital for treasury stock. All right, and now we originally bought 1,600 shares of treasury stock. In that last journal entry, we sold 1,000 shares. Now Riley's issuing the other remaining 600 shares. Now remember, it came into the treasury at 90. It's going to leave the treasury at 90. So 600 times 90, that's your $54,000, which will credit treasury stock. But how much did we receive? Only $75 per share. 75 times 600 we're only receiving cash of $45,000. The difference between the original, which is $54,000, and the cash we're receiving, $45,000, this is a $9,000 difference. We're going to debit additional paid-in capital for the treasury stock. Now, the only reason I'm able to debit additional paid-in capital is because I established it. Let me go back. I established it over here with a $25,000 balance. So I can write that down. I have room to debit it for $9,000. Now, I want to say one thing here before I flip to the next slide. If there was no additional paid-in capital for treasury stock, you wouldn't be able to debit it. What you would have to do is debit retained earnings. So be very mindful of that. The additional paid-in capital in a situation like this, where we sell the treasury stock for less than what we originally purchased it for, we will debit additional paid-in capital dash treasury stock if we have it, if we have available balance to debit. You can never go below a zero balance. You can't go into a debit balance situation with additional paid-in capital. All right, when we do, instead of debiting additional paid-in capital, you would debit retained earnings. You would never record gains or losses on selling treasury stock. That's not what the business is there for. The business is there to sell product or services and not earning gains and losses on selling their own stock. Okay, that's why we don't see any. That's why we don't see any gains and losses here.